Well, good morning. I'm sorry not to be able to be with you in person in Stockholm. My subject that I'm going to talk about today is money and the credit cycle. And when you actually see this lecture, I will be in China looking at issues to do with credit and money creation and the dangers that credit expansion in China is heading towards a crisis. So I will be in an appropriate place, but it would also be very appropriate for me to be talking about this in Stockholm, in Sweden, because I think the Swedish School of Economics in particular, and in very particularly Knut Wicksell, had some insights into the nature of credit creation and what that does within an economy and the challenges that come from that, which were subsequently developed and explored by early and mid-20th century economists such as Hayek and Fisher, but which I will argue have been to a significant extent ignored or assumed as unimportant by much of modern macroeconomics. So in part, what I'm going to talk about this morning is a piece of intellectual history, but with a very clear conclusion. And the conclusion is that the credit cycle and the level of leverage in an economy, that these are crucial economic variables which we need to pay attention to and did not pay adequate attention to before the crisis, and that in order to pay attention to them and deal with them effectively, we need to go well beyond the current new conventional wisdom that we need to add financial stability as a parallel but separate focus to monetary stability. I will assert instead that we need a whole new mindset and an integrated approach, integrating across monetary policy and financial stability issues in order to control and constrain the credit cycle. So that is the theme that I'm going to set forward. Can I just say a quick word on the technology of how we're going to do this, which I hope is going to work. Behind me on the screen, you will see that there are some slides, which, however, you can't see because I am in the way of them. But I hope that you have been provided either on a separate screen or with a physical printed copy of the slides, which I hope will help make the communication work a bit. But in order to make sure that you can see where we are in the process, as I change the slides, I will mention the number of the slide that we are on. Let me begin with Knut Wicksell's fundamental insight, which was based upon the analysis of the way that credit extension creates purchasing power. Wicksell was already operating in an environment where most payments were no longer notes and coins. They were credit-based. And he asked the question, what are the consequences of payments being based on the basis of credit rather than notes and coins? And he began by pointing out that even if you had what he called a simple credit economy, in which credit was simply extended on a bilateral basis between businesses, that in itself would create additional purchasing power above and beyond that which exists on the basis of pure metallic money. But then he said if you go beyond that and have what you call a system of organized credit, by which he meant a system with commercial banks and with deposit money as the fundamental form of payments, he asserted that that clearly created purchasing power and created it ex nihilo, out of nothing, that new purchasing power was created. I think, and if we look at the first slide, that this is a fundamental insight. We sometimes say that what banks do is they take deposits from households and they then lend it to entrepreneurs or businesses. I think that is a bad description of what banks do. I think we need to fundamentally understand, as Wicksell asserted, that what banks do is they create both a loan, he assumed it was a loan to an entrepreneur, and the money in that entrepreneur's account. That creates purchasing power. the fact that it creates purchasing power crucially depends upon maturity transformation, on the fact that the loan is of longer tenor than the deposit. But that insight is, I think, fundamental, and I think too much lost in, certainly, undergraduate economics textbooks, but even, I think, in more advanced economics. Wicksell then asked the question, okay, well, if credit, and in particular bank-organized credit, creates purchasing power, what constrains that purchasing power creation? Or do we have a problem that it can simply go on growing limitlessly and therefore create inflation? And so you asked the question, and we turn now to my second slide, what is it that limits bank credit creation? And what is it that freely limits it before we introduce the idea of an authority attempting to constrain it? His assumption was that banks would freely choose to hold reserves, cash reserves or reserves at the central bank, and that the fact of those reserves, the need to hold those reserves in some proportion to the size of their balance sheet, constrained credit and money creation. But then he noted three ways in which the degree of those constraints would change over time. First of all, he said, the more payments go through a gyro system rather than a cash system, the more at the level of the total banking system, you don't really need reserves, because you don't have to deal with the fact that people will suddenly decide to take a physical cash, paper cash, or coin cash out of the banking system. Secondly, and I think this was a really crucial insight, he asked the question, what if the banking system was organized as one bank rather than many competing banks? In that environment, you could be certain that when the entrepreneur who had received the loan spent the money from that loan, although it would leave his account, it would be bound to end up in an account of somebody else at that bank. And he said, well, the more that the banking system is organized as one bank rather than many banks, the less freely constrained it will be. Thirdly, he noted the fact that, at least as his time, international payments were not entirely done on a credit basis. There still was movement of precious metal gold bullion, or at least claims to precious metal gold bullion. And he said that the fact that there was still a metallic money anchor would somewhat more constrain credit creation than you would have if an economy was entirely closed, or indeed if the entire world economy also fundamentally made payments on a credit basis. Now, those three insights, I think, are very important to what then happened over the subsequent 100 years. And I'm going to argue later that those three constraints, they change over the 100 years, and they make the credit cycle less and less constrained. And I'll come back to that later. But Wicksell's fundamental insight, if I return to it on the next slide, slide 3, is that banks create credit and purchasing power. And the way he believed that this was constrained beyond the constraint that would be freely arising from banks' behavior would be if a central bank made sure that the money rate of interest, which was influenced by the central bank, was equal to the natural rate of interest, where the fundamental concept of the natural rate of interest is pretty much equivalent to the MPC, as I call it there, the marginal productivity of capital. I think Wicksell's insight into the nature of credit creation was fundamental. I think in two ways Wicksell's insights are still limited. One, he assumes that all credit is extended to entrepreneurs to make real new physical investment. And that turns out not to be true, and I'll come back to that. And also, he assumes that the fundamental problem that we're dealing with here is whether too much credit creation creates inflation. It's a price stability issue. And I think that is a limiting assumption. It is the limiting assumption which most modern macroeconomics and pre-crisis central bank orthodoxy has also accepted, that the fundamental issue is price stability. A subsequent series of economists, and I'm going to talk about Hayek, Fisher, Minsky, and Simons, I think correctly identified that credit creation had a set of other implications that go beyond price stability. and it's those that I would like to explore before then thinking about how modern economics has dealt with it. But before turning to those points, I think it's useful to step back and consider the role of credit relative to other options to create adequate demand. Because if Vixel is right that credit creates purchasing power, I think it is useful, and if we now look at slide 4, to think about credit creation as one of two alternative ways to make sure that nominal demand, aggregate nominal demand, is adequate within an economy. Let's think about the problems, which of course people did think about at the time of Vixel, about a pure metallic money system, a system of a gold standard. If it was truly pure metallic money and there was no either simple credit or organized bank credit, then clearly the money supply would be constrained by precious metal resources. And of course, many people in the late 19th century worried about the implication of that. And they said, here is the problem, that if our money supply is constrained by real precious metal resources, it may be that we can only achieve an adequate level of real growth if we have a downward flexibility of wages and prices. And it may be that downward flexibility of wages and prices is in itself disruptive to real growth or is unattainable. It is also the case that in an environment of pure metallic money, you can, what the early economists described you can have savings actually taking the form of pure hoarding. If somebody saves in a pure metallic money environment and actually puts metal coin under the bed, it is truly removed from the economic circulation in a way which is not true of savings within an environment which has a credit system and bank money. So there can be a set of problems to do with an inadequacy of aggregate nominal demand. Now, of course, if we believed that the economy is so flexible in terms of real wages and prices that it will automatically get at a reasonable equilibrium whatever the money supply, then this doesn't matter. But actually, most modern macroeconomics and most policy has converged to the belief that the optimal way to run the macroeconomy is to have a low and positive inflation rate and therefore a rate of a nominal GDP growth, which is, let us say, for an advanced economy in the region of 4% or so, allowing for 2% real growth and maybe 2% inflation. If that is the case, if that is the optimal way to run a modern economy, you have an issue of where does that aggregate nominal demand come from? And I think it's useful to think about two alternative ways that it can come. First of all, it can come from pure fiat money creation. A state can create money and can spend it. It can run an unfunded fiscal deficit, and it can cover it with money. And as I'll say in a minute, there have been environments where that has been a successful way of stimulating economies. But we have tended to be very wary of that as a way forward for creating aggregate nominal demand, and credit creation is an alternative way of doing it. So one of the ways to think about private bank credit and money creation is it is a way of creating aggregate nominal demand growth in a way which is an alternative to pure fiat money demand growth. And if you look at some 19th century commentators, such as Walter Bagehot, they were convinced that the development of the banking systems in countries like England had enabled an expansion of aggregate nominal demand, which was not possible in a country like France, where Bagehot said the trouble is that extra saving can take the form of pure hoarding. So I'd like to suggest that it's useful to think about pure fiat money creation and private money creation, private bank money creation, as two alternative ways as overcoming the problems created by limits of metallic money. I think it's then useful to think about the advantages and disadvantages of those. Fiat money creation is always possible. And you could say, and the great news is that the public authorities can choose the optimal amount of fiat money creation. And I think it's important to realise that there have been successful periods of economic history which have involved the creation of fiat money spending power by the authorities without that getting out of control and without that leading to hyperinflation. If you look at the period of US history, which is the Civil War and the immediate post-Civil War period, where the US Treasury created greenbacks with which it paid the Union Army, this was a perfectly successful use of fiat money creation, which did not lead to an excessive rate of inflation. But we've always been worried, or there's a tendency to be worried, about fiat money creation because of the disadvantages on the right-hand side of this slide. First of all, the fact that if you are creating new fiat money simply by running unfunded fiscal deficits, the allocation of those is a political decision, and then that can drive either wasteful investment or the rewarding of specific political constituencies. And second, of course, there's a very strong fear that the moment you accept that we can create new nominal demand with fiat money creation, that we will do it to excess. And then, of course, we talk about the hyperinflation periods of Weimar Germany or, more recently, Zimbabwe. So compared with that, creating additional credit by additional spending power through a private credit creation might appear to have two advantages. First of all, the allocation is determined by market disciplines, supposedly, and secondly, the optimal amount might, we suppose, be ensured by an interest rate policy in line with Wicksel's approach, where the money rate of interest is held close to the natural rate of interest. I think we can see the fundamental problems which are created by the credit cycle as relating to the question marks on the right-hand side of this path. Do those advantages truly exist? Or can we have situations where the allocation of privately created credit is as undisciplined and as problematic as maybe fiat money creation, where the interest rate control process of the money rate of interest equal to the natural rate of interest is not an effective control. And a third issue, problems arising from the fact that if you create aggregate nominal demand by creating additional private credit, you leave an ongoing debt contract, and ongoing debt contracts in themselves have consequences. With that as background, let me now talk about three categories of problems in credit creation, which I think are problems beyond that on which Wicksell focused, beyond the problem that there might be too much credit and therefore a price stability issue. And these problems arise from the fact that banks create credit, money and purchasing power, and therefore it matters to whom credit is extended, and we have to investigate to whom credit is extended. And as I said on the previous slide, credit creates ongoing debt contracts, and those have consequences. And it's because of these that we have consequences going beyond price stability. Consequences that we can just usefully, somewhat arbitrarily, but I think usefully categorize under three headings: Hayek, Minsky, and Fisher-Simons. First then, Hayek. Investment and over-investment cycles. As I said, Wicksell tended, like a lot of modern economic textbooks, to assume that every time you extend credit, you extend it to a business to invest in real economic projects. So too largely did Schumpeter, and so too did Hayek. And let's assume for now that that is the case, that fundamentally we're talking about credit extension in order to fund new physical capital investment. Once you understand that that is what credit could be for, there are two consequences, one of which could be positive for growth and the other of which could be harmful for the volatility of growth. The one which is positive for the growth is the fact that if credit is extended primarily or entirely to businesses and entrepreneurs or to other categories of investor in real capital, such as a local government investing in an infrastructure project, then the extension of credit can skew demand towards investment and away from consumption. And it can therefore produce a higher rate of savings than would occur in an environment where all credit was extended on a direct basis and where you had to get an individual household to make a conscious decision to save. And from that comes the concept, which I don't think we talk enough about now, but I think is a valid concept, which many of the early mid-20th century economists wrote about, which was forced savings, the way that the credit allocation process can produce a higher level of savings than would otherwise occur. Hayek, in the monetary theory of the trade cycle, describes it, as you see on this slide, as an increase in capital creation at the cost of consumption through the granting of additional credit without voluntary action on the part of the individuals who forego consumption and without them deriving any immediate benefit. I think that concept of forced savings, an investment skew within the credit allocation process, I think that is theoretically possible, and I think there is empirical support for it in economic history. I think if you look at the development, for instance, of Japan and Korea in the 1950s and 60s and 70s, I think there's a very reasonable case set out, for instance, in Joe Studwell's recent book, How Asia Works, that the use of the banking system, along with financial repression, i.e. below free market interest rates on household deposits, and the conduit of cheap credit through the banking system to industry, and particularly heavy industry, was part of achieving a higher rate of investment and therefore a higher rate of growth. However, the moment you mention that, one also realizes that can be a downside. As I said earlier, when you hear this speech, I will be in China looking at issues to do with the credit cycle there. I think there it's clear that the authorities have used credit extension through the banking system to drive an investment-led economy. And that high level of investment has been crucial to a high rate of growth. But the moment you realize that it's been crucial to a high rate of growth, one also realizes that there can be potential disadvantages as well. You can end up creating over-investment cycles in which you end up wastefully investing at a low rate of marginal productivity of capital, and you can create an economy which is so much dependent on demand for investment created by credit extension that you have a fundamental imbalance between the amount of capital being created and the consumption demand for the consumption goods that capital will produce. And I think China now faces a major problem of how it can migrate out of that situation. So that if we look at the Chinese figures on the next slide, slide 9, we are seeing in China, through the banking system, a huge expansion of bank credit, a very big increase of this variable with that China uses, total social finance to GDP, which has been soaring over the last 10 years. And this now is producing major concerns about an overinvestment cycle and an unbalance of the economy. In China, of course, some of the problems come from a politicization of the credit allocation process. But before we assume that that's a special case, I think we should note that we have been through a recent Hayekian overinvestment cycle in countries like Spain and Ireland. This next slide shows one of the many almost entirely empty provincial airports that have been built in Spain. And we have an illustration of the fact that even a free market banking system can end up creating too much credit in those cycles. So we can have overinvestment cycles in a Hayekian sense, even if we are working on the assumption that all of credit is extended to support real investment in physical capital. But in fact, in modern economies, most credit, contrary to the textbooks, is not extended for that reason. I think it's useful for us to think about the different categories of the way that credit is extended. It is sometimes extended as loans to businesses, entrepreneurs, to finance real investment projects. And we're on slide 11 now. It's sometimes extended as loans to business speculators or investors, simply to finance the purchase of existing assets. It's extended as mortgage loans to households, which supports intergenerational asset transfer, which sometimes finances new physical construction of houses, but sometimes simply the purchase of existing houses. And it is loans, unsecured credit, to impatient houses, to temporarily cash-limited houses, or simply to poorer households. Estimates that I've made of the balance of the UK in 2009 suggest that out of 1.9 billion bank credit extended, really only 232 million, so not much more than about 13 or 14%, is clearly provided to support the sort of productive investment projects that Hayek, Schumpeter and Wicksell assumed was the whole of the credit creation process. Another slice is essentially supporting commercial real estate, which involves some new physical investment in new real estate developments, but also quite a lot of pure asset play in existing assets. In the UK, the vast majority of credit, about 60%, 60 or 70%, supports residential mortgages, which in the UK has not actually supported a construction boom, but is primarily supporting the finance of already existing assets. And a significant slice supports pure life cycle consumption smoothing and has really nothing to do with assets either new or existing. Once you realize that that is what credit does in a modern economy, I think we introduce a whole new possibility of the impact of credit, which is that credit can, in the fashion that Hyman Minsky described, create cycles of the price of existing assets and the amount of credit extended, which are self-reinforcing cycles. Increased credit extended drives increased asset prices, which then drives changes in the behavior, the apparent net worth, and response to the incentives facing both borrowers on the small inside cycle and lenders on the outside cycle. Borrowers note that the price of these assets have gone up and believe that it is then sensible to borrow more money, and the demand for credit goes up. Increased asset prices produce for a period of time low credit losses. That increases the net worth of banking intermediaries. It reinforces the belief of bank credit officers that it is sensible to lend money against these existing assets, whether they be commercial real estate or residential houses, and therefore the supply of credit goes up. The supply of credit goes up and the demand for credit goes up. More credit is extended and asset prices go up further. These cycles of credit and asset prices of existing assets are, I think, fundamental to the dynamics of credit in a modern economy. And one of the implications of these, I think, is that the interest rate elasticity of demand for credit is probably highly variable across different categories of credit, and that this is a fundamental problem for Wicksell's thesis that we can simply constrain the credit cycle by focusing simply, as modern central bank practice has tended to do, on making sure that the money rate of interest is appropriately set. Wicksell, assuming that we are fundamentally talking about finance for new investment projects, says as long as we have the money rate of interest equal to the natural rate of interest, all will be well. But actually, as it shows here on the right of this slide here, slide 14, I think the interest rate elasticity of demand will vary significantly by use category and across the cycle in the light of expectations of asset price trends, which are themselves endogenously driven by the supply and demand for credit. That means that if you try to slow down a commercial real estate lending boom by increasing interest rates, you are likely, I think, to do significantly harm to real productive investment in the non-commercial real estate sectors of the economy long before you slow down this boom in the commercial real estate area, where the estimates of an acceptable interest rate to pay are being driven by the expectation of asset price increases. You therefore have a danger that if you simply rely entirely on the interest rate to control credit cycles, you get the problem which Raghu Rajan referred to in a recent lecture of the economy may get too many buildings and too few machines. Let me turn to my third category of arguments about why credit can create problems which go beyond those covered in price stability. And these are the arguments which Irving Fisher and Henry Simons set out. The crucial point is that while credit creation creates purchasing power, it also creates ongoing debt contracts. And ongoing debt contracts create rigidities in the economy. Simons and Fisher believe that those rigidities created by ongoing debt contracts were fundamental to the fact that a boom of excess leverage up to 1929, when it burst, had created the crash of 29 and the Great Depression thereafter. And their analysis basically was pointing out that debt contracts are fundamentally different from credit contracts. Now, on this slide, I've set out some of the ways, the distinctive characteristics of debt contracts. These arguments have been made elsewhere, and in the paper I'll be distributing, I talk about the literature, so I'm very, very quickly going to mention them. Four in particular. First, with debt contracts, there is a danger of what Andrei Schleifer and others have called local thinking myopia. People are simply fooled in the good times into believing that risky contracts are riskless contracts, and therefore there is a tendency for debt contracts to be created in excessive amounts. We get many debt contracts which, in their words, owe their very existence to neglected risk. Secondly, debt contracts, when they turn bad, don't turn bad in a nice, smooth fashion. They turn bad with the rigidities and the costs of default and bankruptcy, which are real-world phenomenon, which are, as Ben Bernanke has pointed out, a direct contradiction of a complete markets world. In a complete markets world, we would never see default and bankruptcy procedures, but in the real world, they exist and they create rigidities. Thirdly, unlike equity supply, debt supply has to be continually rolled over. That means that the new supply of credit is a crucial variable of macroeconomic importance. And finally, the more debt you have, the more leveraged is net worth. Therefore, the danger that when you have a shock to asset prices, you have a leveraged effect on net worth, and that can then drive the behavior of highly leveraged agents, whether they be households or corporates, who in the situation of being highly leveraged do not make decisions about incremental investment projects on a classic marginal basis, but are focused very heavily on simply paying down their debt in the way that Richard Koo, I think, has insightfully described in his description of what he calls a balance sheet depression in Japan. These features of credit, of debt, could exist even if all debt was provided on a direct basis, i.e. if it was all individual households buying corporate bonds without banks. Indeed, I think it's quite interesting if we look at the next slide, which is slide 16, that if we set out Irving Fisher's famous 9 steps of debt deflation dynamics, most of these, I won't read them, but you can look at them on the chart or in the paper afterwards, could occur even if we were talking about direct debt rather than bank debt. And I think they make the total level of debt to GDP in economy, private debt to GDP, an important variable, irrespective of whether that debt is created by banks or in a direct fashion. But banks increase the risks that debt will be created in excess amounts precisely because they can create credit and money and purchasing power. And for those reasons, Irving Fisher and Henry Simons ended up in a really very radical position. They believed, as the quote from Henry Simons on the left-hand side of this chart, from 1936 sets out, that in the very nature of the system, banks will flood the economy with money substitutes during the booms and precipitate futile attempts at general liquidation thereafter. Simons believed that banks, fractional reserve banks, were such a pernicious creation that we should abolish them. And this is a man, Henry Simons, who is a foundation figure of the Chicago School of Economics, who in almost all of the rest of his economics is one of the most radical and complete free market laissez-faire economists. He believes that the banks are such a special case that we should essentially abolish them. And he and Irving Fisher believed that the ability of banks to create credit and purchasing power, envisaged, correctly understood by Wicksell, was so dangerous that it ought to be abolished. We should not have fractional reserve banks. We should have 100% reserve banks. In that environment, the monetary base equals the money supply. Of course, that then takes us back to, yeah, but if that's what you do, where does aggregate nominal demand growth come from? And Irving Fisher and Henry Simons recognized that if you abolished fractional reserve banks and you want aggregate nominal demand growth, you would have to have fiat money creation. You'd have to have the government run fiscal deficits on a small amount and fund them with fiat money. They accepted the implication which came out of that. So let me sum up where I've got to so far, and then I'm going to very quickly come to conclusion. Wicksell identifies that banks create credit and purchasing power. He focuses on the implications of that for price stability. How do we make sure that this creation of purchasing power doesn't run out of control and create inflation? But actually, when you think about it, there are lots of other impacts of credit creation. We can have the beneficial, but also potentially harmful fact that credit might be skewed towards investment rather than consumption, potentially beneficial in some circumstances, potentially a source of instability in others. We can have, once we realize that credit is provided for a lot of other reasons apart from new investment projects, and in particular funds, asset price cycles, we can have Minsky-style asset price cycles. And we can have deflationary consequences resulting from the fact that the flip side of creating purchasing power with credit and money creation is that you create a set of ongoing debt contracts thereafter. These insights, I think, are fundamental. In the rest of my paper, that I'm very going to quickly tell you the highlights of now, I make two arguments. First, that there have been a set of developments over the last 50 or 70 years which make those fundamental insights of Wicksell, Minsky, Fisher, Hayek even more important than when they wrote. Secondly, that bizarrely, while the credit cycle and understanding the credit cycle has been becoming relentlessly more important, modern economics, macroeconomics, has tended to go in precisely the opposite direction and to pay less attention to it. Let me very quickly set out those two arguments, but you will have to look at the paper to understand them in more detail. First, on one slide, slide 18, my argument that the financial system and the credit creation process has become increasingly important over the last 70 years. Why? Four factors. First, we have had a dramatic increase in leverage, and we've had a dramatic change in the mix of credit categories, so that now they are totally dominated by credit extended either to households or to fund the purchase of existing assets, and investment funding has become a small part of what the bank or shadow bank system does. Second point, I think there's a reasonable argument to say that if you think about Wicksell's three possible constraints, freely arising constraints on the credit cycle, all of those have weakened. the process of deposit insurance, the institution of deposit insurance, has made it far less likely that the banking system in total will ever subject to a total banking system run, that people will take money literally out of the whole banking system. Secondly, I think the development of the interbank system has enabled banks to hold not reserves, but claims on other banks, and to treat those as their liquid assets. And the more that banks do that, the more that the banking system in total is acting as if it is a Vixelian one-bank system. That, of course, depends upon risk assumptions in the interbank system. And I would simply suggest that we can think about what happened in autumn 2008, when the sudden introduction of risk perceptions into an interbank system previously thought of as risk-free was, in a sense, a flip from the system working as a Vixelian one bank to the system working as a multi-bank system. Thirdly, international payments have lost all their link directly to metallic gold or to even a claim on metallic gold, and they have become all credit-based. Add those three together, and Vixel's idea of the naturally arising constraints, that weakens. Third, I think that it is important to understand that securitization and shadow banking, through the introduction of mark-to-market collateralization and value-at-risk techniques, has both turbocharged the credit cycle and made it almost written in to the system. It's hardwired it into the system. And fourthly, and I'll have to skip over this very quickly, I think that the flip side of the credit creation, for lots of reasons, is that the nature of what money is has changed as well, in a way which has made any attempt to trace the importance of the banking system through a focus on transactions money and the transactions demand for money has become decreasingly useful. And indeed, I think it's ended up in a situation where what we actually mean by the demand for money is an almost meaningless concept. So my argument is a set of developments, all of which have taken us in the direction in which we should have paid more and more attention to the financial system, and in particular the credit intermediation system. What did we do? Well, two quotes from last October. Olivier Blanchard. Before the crisis, we thought we could ignore the details of the financial system. Mervyn King. Within the dominant neo-Keynesian model of monetary economics, it lacks an account of financial intermediation, so that money, credit and banks play no meaningful role. And that, I think, is broadly speaking true. And it's interesting to ask ourselves, how did that happen? How did we end up with ignoring this increasingly important factor? Now, in the interest of time, I'm going to skip over my next two slides, but they and the text set out some thoughts on the way that a post-war, even Keynesianism and monetarism tended to ignore the credit creation process and either think in real variables such as C, G, Y, and I, or in terms of money alone rather than credit. I think there was then a subsequent period in the 1950s to 70s when people like Gurley and Shaw and Tobin and Minsky did try and reassert a focus on credit variables in the financial system, in particular the vital insight of Gurley and Shaw, the concept of inside money, where the money creation creates an ongoing debt contract rather than outside money, which does not. But something happens from 1970s and 80s onwards where both modern neoclassicism and modern neo-Keynesianism pushes back against that and really ignores it. I think there are two key elements within that. I think Modigliani and Miller pushed us towards believing that capital structures don't matter. And I think there was a dangerous tendency to assume that if that was true or had any truth at the micro level, that was true at the macro level as well. And I think there was a process where in our search for the micro foundations of macro, we turned out not to be able to derive micro foundation models which were both mathematically robust and realistic, and we favoured mathematical robustness in the representative agents model above a reality. So, in my paper, I talk a bit more about that intellectual history, but I think the effect is very deep. I think it is reasonable to say that both in undergraduate textbooks today and in advanced economics and in central bank orthodoxy, we have tended to work on a way of thinking about the credit creation process which is simply not true. If we skip now to, slide 22, which is entitled Modern Textbook Assumptions, I think it's fair to say that they make three assumptions which are dramatic and wrong oversimplifications. They tend to assume that what banks do is take deposits from household depositors and lend it to borrowers. That misses the insight that banks create credit and money and purchasing power. They tend still, and I have read back through several economic textbooks over the last month to check this, they tend to say that what banks do with that money is they lend it to businesses in order to fund those projects which have a higher return than the interest rate. And that ignores almost entirely the fact that most credit extension is no longer funding business capital projects. And they tend to talk about the way that we can get a handle on what is going on here with a demand for money which is a function of interest rates and the interest rates and why the nominal demand level in a way which I think totally fails to capture the reality of these many impacts of credit which cannot be captured in that simple form. And if that is true of the textbooks, it is also true of the advanced treatments. As Mervyn King said, if you take the canonical statement of neo-Keynesian monetary theory, which is, I guess, Michael Woodford's Interest and Prices, which was of course, titled in homage to Wicksell, I think, although it is a very, very fine piece of work in many ways, what is startling is that in an investigation of monetary theory, the role of the banks and the role of credit creation in its detail is almost entirely absent. Let me try and sum up what I'm saying and what the implications are. I think on slide 23, we have to think about a banking system and its impacts as fundamentally important because it creates credit and money and it allocates that credit to specific uses and agents. As a result of that, credit creation has an impact on nominal demand and on price stability, yes, but it also has it on the investment and the consumption cycle. It can produce real investment over investment cycles. It can produce self-reinforcing existing asset cycles. And because it creates ongoing debt contracts, it creates debt overhang and deleveraging risks. Modern macroeconomics has tended to cut through that extraordinary complexity and focus almost entirely, this is exhibit 24 here, on one dimension, one vector, the way in which interest rates and interest rate expectations cut through the banking system almost as a veil and impact nominal demand, which in relationship to the output gap and with some expectations in there as well and some sticky prices produce price stability. I think that way of focusing on price stability is inadequate, and I think if we go back to the key insights in Wicksell, although he focused primarily on that, it becomes obvious we have to focus on other things as well. What are the implications of this for policy? 5. Price stability alone is an insufficient focus, but also financial stability alone is an insufficient focus. We cannot focus simply on whether our banks are going to be solvent or not, because we could have credit cycles created by still solvent banks. Credit cycles matter in themselves, categories of credit matter in themselves, and levels of leverage matter in themselves. That, I think, means that we have got to be proceeding not by simply adding financial stability as a new standalone central bank responsibility, but heading towards an integrated management and constraint of the credit cycle via a combination of interest rate policy, macroprudential tools, I believe the restoration of the use of quantitative reserve requirements, which of course Vixell believed were an obvious way to constrain credit growth, and direct constraints on categories of borrower. Let me end with a final comment on that suggestion I made earlier, that you can think about private credit creation as one of two ways of ensuring that we have aggregate nominal demand. If we had a pure metallic money system, you have a danger of inadequate demand. You can make up for that by fiat money creation, but we tend to be terrified of that because of the political allocation and the dangers of excess. Therefore, we have a system which has private allocation of credit, and that allocation of credit is crucial to, and that creation of credit is crucial to the creation of aggregate nominal demand. That has some advantages. But the crucial point is it also has consequences that require very careful management. I'm actually recording this on August the 22nd. In yesterday's Financial Times, August the 21st, I read a very interesting discussion of people's worries about increasing emerging market leverage and reference to a concept that people are increasingly talking about, which is the credit intensity of growth. It said that it was now clear that Singapore and Hong Kong, that the credit intensity of growth, which was defined as the amount of credit growth required to drive GDP growth, had doubled. Now, think about the credit intensity of growth. Suppose that credit to GDP, debt to GDP, was already 100%. And suppose you said that the credit intensity of growth at the marginal level, suppose this concept is right, was 2, i.e. that you had to create 2 units of extra credit for actually 1 unit of GDP. It would be inevitable that the leverage level of the overall economy would go up. So I think we have a concept here of a credit intensity of growth, which could mean that we're suggesting that in order to have GDP growth, we need not simply to have a high level of leverage, but a relentlessly rising level of leverage. That, I think, must be wrong. That must be dangerous. And I think we need to reflect very carefully about what is it about the way we have run our modern economies that we seem to be assuming that in order to have adequate GDP growth, we need a level of credit growth which results in a relentlessly rising level of leverage. Thank you very much, and I hope that I'm now going to appear in person from China in about 3 weeks' time. I hope that that part of the system works. Thank you.